Happy Friday, everyone, and welcome to the Real Life Real Estate Investing Show, where we try to show you how to get your real estate wealth on. Today, we have a very, very, very special show. I say that almost all the time, but this one's like extra, extra special. As you all know, my name is Hector Hernandez. I am a real estate fund manager, as well as a coach and mentor here on reallifetrading.com. Joining me today, as always, is my buddy, my pal, my co-host, Mr. Luis Alejandro Lopez, as well as a very special guest that you guys are going to get to meet in just a second. Luis, what we got today? What's so special about today?
Oh, man, what's so special about today is that what I posted earlier today. We here in a group, we all really, really, really good at making ours, and that means making money. But we're going to see that if you make money in the stock market, what happens with that money? Until Sam comes in and look, he's going to make a big chunk. Now, there are ways to shelter that money, shelter some of those profits in real estate. There's no way to do it on stock market, whatever. You took a trade, you make your wins, it's short-term capital gains, ding, ding, you need to pay. We're going to see now, Patty's going to talk to us and walk us through several ways why biggest millionaires are done in real estate, because it's not what you make, it's what you keep, and what you keep for yourself, what you keep for your family, what you keep for your family's family, for your grandchildren. Generational wealth gets built on real estate. First of all, again, we are two guys on the internet. We've done a lot of stuff. We talk to a lot of people. The people that we bring, they really know what they're talking about. But we're still two guys on the internet. So please, before you make a decision, before you buy any property, before you sign a dotted line, before you get a loan, before anything else, just ask questions, talk to people, talk to your friends, talk to a realtor, talk to an attorney, talk to somebody else. Getting in and out of real estate, it's not as easy as it seems. It's not like clicking a couple of mouses, you are a trade. It's going to take time. You're going to lose money. You're going to lose your hair. It's complicated. So please, please, please. All right. Ask questions. We're here. We're going to give you all contact information so you can ask us whatever questions. Look at deals. See if you have any deals that come into your table. Hey, let's have a look at it. Maybe they're really, really worth it. We can jump in with you. Capital, work, whatever it is. If you don't want to pay attention to us in any case, we're just here to entertain you guys. All right? So,
actually, before you get off, I'll add one more thing to that disclaimer, because today we're going to be talking about CPA and that the tax type loopholes and things like that. Not loopholes, legal stuff. But I do want to kind of stress the fact that although Pat is a CPA, she is not your CPA. She's my CPA. She is not giving you any financial advice. So please make sure if you want financial advice, you hire her or pay her. Nothing that we say here today is financial or tax advice.
And keep in mind, everybody's situation is different. So
yes,
taxes are going to be different. So just talk to a person that looks at your case in detail. Okay? And let's go from there. Now, whenever I told you we are here, you can contact us. There you go. We got our QR code. Just screen that with your phone. It's going to give us all the contact information. If you want to invest with us, you're going to have a list, a form that we have. And this picture really, 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 really applies in today.
Yes, right? It does.
Yep. Because we're going to see a lot of things where we can, Patty's going to walk us through. It's not really loopholes. They are there in the law, and they are there to be used. So it's up to you to use them or not. So here we go. Hi, Pat. How are you?
Hi there. That is a great introduction, and thank you for all the caveats. Want to make sure that people don't listen to what we say and run off with it. May or may not apply to their own situation.
Exactly.
So, Pat, tell us a little bit about yourself and your background and your firm.
Yeah. So I'll give you a short story of how I found my calling in tax. Right? I don't think you'll find a kid that says, "Hey, what do you want to grow up? What do you want to do when you grow up?" I bet you nobody says, "I want to do taxes when I grow up." Well, I was one of those strange kids. So one day, I have immigrant parents. They barely make any money. Their taxes are realistically very, very simple. But anyhow, one day from either junior high or high school, I come home from school. I found their tax returns on the dining room table. I'm nosy. I take a look and I found some mistakes. So yeah, like, seriously, kids don't know anything about taxes. So it's probably mathematical error or maybe spelling error. And I thought, well, gosh, you pay somebody to do this and there's mistakes. And it's, really because their stuff is so simple. It's a few pages. And I thought, well, how hard can this be? Like school stuff seems more harder than this. So I go, let me give this a shot. And I go to the library. Now I'm dating myself. They still have everything in print. IRS publications out in printed format. Um, and you'll find a ton of those during tax season. So I asked the librarian, I go, oh, is this stuff free? And she goes, yeah. So I just picked up one of every pamphlet, every booklet that was IRS related, took the whole thing home. Publication 17, still around, but it's on the internet now. I read it from cover to cover. And it's like not brain surgery reading. It's actually very clear cut, like if this happens, try this or try, they give you examples, A, B, C, and then maybe if that happens, try this, A, B, C. I'm like, oh, wow. Oh, look at this. Oh, look at that. Like, oh my God, look at all the stuff you can do it's not just one path, right? There's so many options depending on how you slice and dice. So that opened up a whole that was a real eye opener, really, to see that there's so much you can do. It's not just a one way, put numbers in and out comes the damage. There are things you can do. So flash forward, I got my degree. I got my master's degree in taxation. Started out my career at one of the big five, now final four accounting firms. Made my stint around private equity firms in real estate. And then 12 years ago, I formed my own firm. With my career being in real estate and taxation, I combine the both. So our firm has a niche in real estate taxation. Majority of our clients are, real estate folks, ranging from mom and pop who are just dabbling into real estate. They're high income earners, they're dabbling into it. And we have folks that are 100% into it. We have family offices that own like 40, 50 entities. I lost count how many properties. They own anything from just your single family home, condo, to mobile home park, to commercial properties like retail strip centers, warehouses, storage units, you name it. I've seen it through my clients. And there are so many strategies you can do with real estate that are not actually applicable to even general businesses. Forget securities investment, but just, it's a unique tax code that is drafted solely for real estate.
Nice.
And like you said, these large high net worth families, they are built on real estate.
Absolutely. That's what we keep hearing. And that's one of the main reasons what attracted me to real estate. And then once I started to learn about real estate, it was the second part that you just said. It was that vastness in real estate, how many strategies and how much there is to do. I've been doing this for 15 years and I feel like I know like this much of what there is to know. I'm like, I'm like just a rookie. I'm a beginner in this game. And that's really what one of the things that drives me, right, is how much more can I learn? How much more can I push? And one thing that I was told very early on and that I learned very on from many of my mentors is that surrounding myself by, experts, legal experts, tax experts such as yourself is really what's going to help you really, really amplify what you could do in any business, but more importantly so in a business like real estate that has, like you said, so many avenues. Because at the end of the day, we say this jokingly all the time, is it's not really what you make, it's what you get to keep.
Right.
I could make $1 million, but if I got to give half of it to the IRS,
I
really only made 500 grand. And it's like, but it's like, well, I could have had 800 or 900 had I done some little things,
Right. Yeah. It's what we call, a few steps forward and few steps back. And that's what you get if you're not careful. I was once in a meeting, and our challenge was to explain a grade school kid what we do. So I took a bunch of candies. I gave the kid 10 candies, and I go, well, you know, in real life, you go work, you earn these 10 candies. In real life, Uncle Sam's going to want a chunk of it. Now give me 3 to 4 back, because that's your taxes.
Oh man, I love it. Was they upset?
Now, if you hire me, you could perhaps give less away.
That is
That's
awesome
fun.
way of putting it for the kids. And then, you know, it's
Actually,
Uncle Sam, like they must not like Uncle Sam now. Like, so that's great.
That
actually,
is
I'll
the
be
number one thing with my clients in their, you know, we're experiencing second generation. They're going to work, and then their first year inevitably they are crushed. They're crushed not because of the work stress, but they're crushed because they look at their paycheck and they're like, that's it?
That's all I get to keep.
yep.
That's it.
Actually, you just remind me. I've started doing that with my kid. Every $10 I give him, I go take 3. That you're not touching those. Those are being saved. Those are being saved.
But what did you explain to them that was for?
No, because every time he goes to buy something, candy, whatever, now instead of me buying the stuff, you go and you talk to the cashier and you do your stuff.
Right.
So one day came up, Papi, well, we have to pay taxes. You have to pay taxes on everything, and that's just sales tax.
Oh yeah, that's
That
right.
was your sales tax. So now every time you gonna buy something, you're gonna take part of it away, and then every time you get money, you're gonna get some taken away. So he wasn't really happy. Oh, taxes suck, Papi. Yeah, they do. But then you explain to them that that's how he goes to school. That's why we have the roads. That's, again, it comes in and out. Ideally, you want to be spent on whatever it is that you want, but you have no control over that. So
Right.
let's see.
And sadly, school doesn't teach kids about taxes.
Nothing. Don't teach anything about money. Then that's the reason why we're here in real life trading.
Yeah.
That's the
Okay.
whole idea.
We're trying to change the system.
Yep,
Oh
that's
yeah.
the purpose.
We're
So
definitely
now,
working on that.
do you want to walk us through a couple of examples? Let's say we are a group of stock traders. Some of us have some cash, and we've been telling for a while, do you need to put it on real estate? So let's say from your first purchase, what would you like to do? What would you recommend to do in order to start, saving that amount? So let's not talk about, multi-million dollar family.
Yeah.
Start from start.
Yeah. Some baby steps, yes. Yeah. So let's just compare. Let's say, Luis, you're the securities market investor, and let's say, Hector, you're the real estate investor, and I'm going to take 2 of you guys to compare, okay? And we're going to do it side by side. So each of you guys say have $100,000 to work with, and Luis, you're going to put it in the market. And I know you can buy on margin, and forgive me, I'm not a securities tax expert. My niche is in real estate, and so I'm aware that you can buy, invest using margins. On the real estate side, we call it other people's money. So with the $100,000, Hector can go put a down payment on a property, and the balance would be from a loan, right? So let's make it easy math. Let's say each of you guys got 200, because I'm going to use 20% down for a house. Right. So with 200, Hector can put down 200,000 or 20% for a property, and he could get, say, $1 million property. That's the other people's money, $800,000 loan. Now, let's talk about now just the market doing its job. So, Luis, you with your 200, tell me how much margin you can, and how much can you buy?
With
You can probably get a
200,000,
4x
I can
on
400.
margin.
Yeah.
So you can get 400. You're
So
gonna buy something at
4x.
400.
So you could get 800 on the 200.
Yeah.
800. Okay. Okay. So then let's just say another 10% return. So Luis, you're gonna get 10% on your 800,000, and Hector, he's gonna get his 10% on the million. So now, if you do the cash on cash, Hector is going to be a little bit ahead of you. Now, let's talk about reporting wise. right? So Hector's going to rent out that property. He's going to report rental income. Because he borrowed money, the loan, he could write off the mortgage interest. You know, I'm sure Louis, you could write off the margin interest. On the real estate side, we can also write off property tax, insurance, maintenance. You know, he travels to the property, he uses his cell phone, all that stuff. So anything related to that property, he can write it off. One other special thing is we could write off what's called depreciation, that it's non-existing in the security side. So depreciation is not a cash expense. It's not a cash outlay, but a tax expense. And very often we can turn a beautifully cash flowing property. Once we factor in depreciation, it becomes a tax loss. So I always tell people, my job is to make you look dirt poor on your tax return. Okay. So then you're going to say, well, what happens then when Hector looks dirt poor, he shows no income? How is he going to get a loan next time around? Well, here's this one thing that people don't know. When you go and present your tax return, lenders will ignore the depreciation deduction. So he still has that income, but that depreciation that drove the cash flowing property into a tax loss, the lenders ignore that.
That's a paper loss.
So he's in the same position as you are, Luis, but he got a ton of write-off. Now he doesn't have to pay as much taxes as you because of that. The other thing is, let's say you guys keep this for the same duration. Now Hector's got tenants in there. Tenants are paying down as they pay rent. They're paying down that mortgage for him. So he's now making money by market appreciation. Secondly, he's making money off because he's saving on taxes. And third, he's making money because his tenants are paying down the mortgage for him. There's nobody doing that for the security side.
Correct. The stocks are there and they're either going up
Yes.
or down, and that's it. Paper is paper.
And some might say you could do covered calls and rent out your stock like many of the really savvy traders in this group do. But it's it often does not equate to the same dollar amount. And again, we took the winner there with the depreciation. And I do want to kind of like reiterate that for those of us who are not familiar with depreciation, it is a paper loss. You did not lose any money physically out of your account. It is all paper. It is all paper. And that is the beautiful part. That's why, what Pat is saying is like the lender is still going to take it into my account. They're going to add it right back into my income because it was never money that I actually physically lost. It was just a paper loss, which is the beautiful part about
something too quick. Basically, the depreciation is that you have a house and it's rented, right? But you painted it, you put new carpets, you put new appliances, you put new everything. Every year that those items get used, they get damaged a little bit. So technically, the carpet gets damaged, the paint gets damaged, the appliances, whatever it is, there's a rate where you can add on your taxes. Well, my carpet got damaged this percentage this year, so I lost that money. And then the appliances this year, and then your roof, and then every part of the physical house gets a little damage per year. Now, eventually you will have to replace it, and then it brings the value back up, correct?
Yeah, we call it wear and tear, basically.
Correct.
Yeah.
So year to year, you are making that money. So even for replacement value, eventually you want to replace it, you save that money already.
Right. Yeah. It's really great way of explaining it. And also another way is, compared to like if let's say you bought office supplies, you buy them, you could go Costco and buy a giant box, right? Like you're not going to use that giant box, but it's like it doesn't have much of a life, and so the IRS lets you write off that whole thing in that year. But if you're buying like a large ticket item, like a building, they're not going to let you write off that entire building in the year that you bought it, even if it's financed. And so what they're giving you is basically an allowance for the wear and tear imposed by the tenants. And for residential property, that's 27.5 years. So the purchase price, ignoring the land, it gets spread out 27.5. For commercial properties, that's 39 years. And that clock starts whenever you put it in service. So even if you buy, let's say, a Victorian building built in the 1850s, you bought it 2013, 2023, doesn't matter. It starts in the year you put it in service.
Yes. And so let's back that out real quick, Pat, because I want to kind of give it's such a valuable thing. So I want to, let's go back to the $1 million property example. Let's say, 30% of that is land value. So now we got a $700,000 building asset value. And if you guys recall, the example was I gave a $200,000 down payment. Now, is my depreciation on my $200,000 down payment or on the $700,000?
The entire million. You take the entire million, and like you said, we carve out land, and then the building is what we would depreciate, because for land, dirt is dirt. There's no wear and tear. It's the building and the stuff inside the building that has wear and tear.
Yeah. So I can essentially say with my $200,000, I got, let's call it $700,000 of value that I can start to depreciate. And like you said, if you could do the math, team, if it's a residential property, divide that by 27.5, and that's the tax deduction that you are allowed to have every single year on that particular building with that $200,000 investment.
Right. And that's a very, very simple, clear cut. There's some more advanced ways, that we probably won't have time to get into, because I want to bring everybody to the whole life cycle of it. Right. So let's say now we've both got this $1 million asset. Well, Hector's got $1 million asset. Luis, you got an $800,000 asset. And let's move it down 5 years. And both of your assets have further gone up in value. Let's say Hector's building is now, instead of $1 million, it's $1.5 million. Now you have the option, Hector, to do what's called cash out refinance. So you can get a new loan. And if you guys were lucky enough, you bought it when the interest rates are high, and then, the last several years, I know the interest rates gone up back up, but during the pandemic years, interest rates were so low, people were refinancing. My largest client, refi all of their apartments, and they got a 2% loan with a triple-digit million cash out, 2% loan, and their monthly mortgage payment was exactly the same as before. So,
I love it.
So now they're sitting on a ton of cash. Tell me, Luis, can we do that on the security side?
No, do I think so?
Okay.
You have to, if you want the cash, you have to sell. Oh, no, yeah, you have to.
Okay, so now let's go into selling. Right, the exit strategy option for the security side. You have one option: you either hold it or you sell it. Right. On the real estate side, we have many options. On the exit, so we could do straight sale, like you said, like yours, straight sale, or what we can have this option along with a sale. You can do what's called a Section 1031. It's called 1031 because it's Section 1031 of the Internal Revenue Code. It's a like-kind exchange. We can exchange that investment property for another investment property, and then that tax bill that would have been associated with the sale now gets pushed back. So it's a deferred strategy. The tax bill never gets wiped out until, of course, somebody dies. Then you'll get the step-up basis. But now, then, when you sell, there is no tax hit. That tax hit, it gets kicked out further down, the line. On the security side, that's not an option. On the real estate side, let's say Hector doesn't want to do the 1031. He says, I need the cash. And we're now into October, mid-October. He puts it on the market. And let's take 30-day escrow. We're tying this out probably Thanksgiving time frame. He can also do what's called an installment sale. So he could sell it, get part of the money in 2023, and maybe 30-something, 40-something days later in January of 2024, he can get the balance of the payment. Because we now split it into 2 tax years, he could basically split the tax hit over 2 tax years.
And if
Or
we take and if we take that second part in 2024 early enough, we can also
Right, you
utilize
get the
it,
cash,
utilize
right?
it,
You get the
yeah.
cash in January, and then we
buy
don't have to
another
worry about
property
the
with more
ex
depreciation, and wipe that tax bill
exactly,
out.
And then
exactly.
and now you bring me to another strategy, which is usually my favorite. What happens if you sell, you get a down payment, okay, and then you give the buyer a loan on the difference of the
Right,
price.
Seller
right.
financing, yeah, which is
With the
similar
Seller
to an
financing.
installment
If you
sale,
do
yeah.
seller
Correct.
finance, what happens with
Right.
your taxes?
In that case, then you pay taxes when you receive the payment as a cash basis taxpayer. So you can stretch that out. In my
Okay.
example, it was only stretched over 2 years, right? I have clients who are doing exactly what you're saying, Luis, in states that are lower property tax, lower property value. So then they could, buy it, fix it up, and then turn around and sell it to sell it to buyers, and then do a seller carry financing, especially in today's environment where the interest rates have doubled. Um, they could earn a pretty good amount, but instead of selling it right today, where they would get hit all of the tax today, they can stretch that out, and you know they would be paying tax based on the duration of the agreed upon payment terms.
Mhm.
Yeah,
So
and I've done that before, and it worked out marvelously.
Mm-hmm.
I took what could have been 100% gain, broke it up over, we did a 10-year loan,
Right,
and eventually they refied, I don't know, like year 7 or 8 or
right.
something like that. But even then, it was like just tiny little increments coming in every year, so it was very, very easy to manage those tax implications.
Right.
I do want to go back a little bit to when you were talking about the cash out refi, because we breezed over a very, very, very important feature of that cash out refi that I love. So you gave the example of after 5 years, the property is now worth 1.5. I paid 1 million for it with a $200,000 down payment. And say I approach a lender now and I go, hey, I originally got an $800,000 loan. I want to refi for $1 million. I just want my 200K back. We do that, and I get $200,000 as a cash out refi. Do I have to pay taxes on that $200,000 that I cash refied?
No.
I love it. So I now got $200,000 of
tax-free money. And why? Because
A loan is never income. A loan is only
Bingo.
income if you don't return the money.
Bingo. A loan is only income if you don't return the money. So
It's
if it's
forgiven.
forgiven.
If it's
In this
forgiven.
case, you're paying it down. And then what's even better is that I am now claiming a deduction on that new payment, right? That new interest payment. So, my deductions also goes up for that new payment that I'm making, unless, I got lucky and I refied at 2%, which I don't know if I'll get lucky like that again. But, like your clients, we're just staying flat, that doesn't happen all the time. But even if, your rates go up or whatnot, team, you just got $200,000 of tax-free income in this example. And that to me it's amazing.
Right.
Let's say that Lewis got that $200,000 by selling his stock, profits in his stock, right? Same scenario. His stocks went from 800 to 1.3. Well, he cashes out $200,000 of that. Does he have to pay taxes on that, Pat?
Oh, yeah.
If he sells stocks and makes a
Yeah,
$200,000
if he
profit,
sells it, yeah.
Absolutely.
he's held it for
Let me
5 years, so it's long term,
Yeah.
right?
There's long-term
It
capital
is
gains,
long,
but still.
right. Yes, there's
But you're
no
still paying
escape on tax on Louis' side. So let me clarify a bit on that. When you take out the cash out refi, now you got 200,000 back. So now the deduction of that cash out refi, the deduction on the 200 that you took out, it would be deductible as long as you use it for investment purposes. So you could take that cash out 200, plop it on yet another property. And if you want to diversify, plop it on the stock market. And then on the IRS side, we would use what's called an interest tracing rule, where the interest would follow wherever that cash went. Now, if let's say you decide to take a world tour, give yourself a break and take a world tour, and you use it for personal, then of course that's not deductible.
Gotcha. Okay.
So
So
you can
there
take that
is
200, buy
Hey, if
another
you're an
business,
American
and
tour,
then
you only spend only 50. Get
yeah,
taxed on 50.
yeah,
And
okay. So there is a limit to what you could do with that cash out money. You can't just
right.
go party it up. You gotta, but okay. So you get to buy another property, get more tax deductions, and
Right,
then take a vacation.
right.
or you become a Instagram guy, and then you put all your pictures and try to make a business out of it. Yeah, there's a business.
There you go. That works too
There's
because
always a way.
we still got tax depreciation going in.
Yeah. All right, but now I got another question. What happens at the very end? Let's say I don't sell the property and we come to the 27 and a half years. What happens?
Good
The
question.
depreciation of the building technically in your papers is worth zero. What happens when
Right.
you sell? If you sell, you're gonna get all that money back. If not,
Yeah.
you do a 1031 exchange, meaning that you swap a property for a property. Okay. Now, what
Mhm.
happens if I don't sell the property? Maybe I put it in a trust. Maybe I put it on my kid's name. If there's a switch on ownership, if that tax becomes due, correct?
Yes. So that's a great question, and that's a pretty loaded question. So I'm going to do with the simple stuff. Let's say,
Yes.
and we're now dealing with a massive amount of baby boomers, right, exiting the market, and we are now seeing, like you said, folks who have owned these properties for a lifetime, and they're at the end of the depreciable life. There's nothing else to depreciate. So
Correct.
on the basis, we're down to only the land that was never depreciated. So in that example, that $1 million property that Hector bought, we've depreciated everything else. What's left is really the land at 300,000. We're now 30 years later, and the building is worth 10 million, let's say, and he sells it. There's no way he's going to be able to pay that tax bill. I would say roughly budget 33% between. Well, you guys are lucky. I don't know where you are, Luis, but in Florida, in states where there's no income tax, you guys are lucky. There's no state tax. But let's just say, for poor folks like me in California, we got federal, we got California. We're looking at easily 35% on that bill. So we're talking about 10 million minus 300,000. That's a pretty ginormous bill. So what are the options? So Hector could hold it forever, put it in the
Living
living
trust.
trust, and leave it to his kids or whoever he wants, and whoever inherits that property would get what's called a step-up basis. So Hector's basis is, dwindle down to just a mere 300. And let's say he passes and his kids inherit it. Now it's worth 15 million. Upon inheriting it, and the key word is they have to inherit it. He can't just gift it away. Okay. The price for that gift, that step up basis, is death. No death, no step up basis. Keep that in mind. With ethnic family Asians, we just love giving stuff away and putting kids' names on the assets because their mentality is, when I die, my kids are going to get it, so I might as well just put their name on it. Well, okay. No, let's backtrack a bit on that. When you gift or just, transferring title from, let's say, Hector to your kids, that's called gifting.
Mhm.
That's just transferring. If that happens, Hector has given away, gifted away 10 million, 15, whatever the fair market value is. In that situation, who pays the tax?
The
That
the
person that
person
got the
making the
gift.
gift.
Yes, not the kids.
Mhm. Okay.
So Hector is going to pay the tax, or a gift tax, or he can make an election to offset that gift by his lifetime exemption amount, which is now like 13 million per person. But that number changes like every 4 years, depending who's in the White House. So we can't bank on that. That 13 million is going to perhaps drop to 5, 6, 3. I don't know. Hopefully he dies in a year where there's a high value. But he's very young, and we're not going to go down that path. But he just cannot just add people's name to that property. That's called gifting. And when that happens, also, the kids inherit his low basis of 300. So basically, yeah, they got the asset, but he's just handing over the tax bill to the kids
Handing over a
also.
big old tax bill.
Yes. Now, compared to, let's say, he leaves it in a living trust and he passed, and then the kids inherit it, then they get a full step-up basis. The other question I get is, what if there's no living trust? Do they get the base step-up basis? Yes, because there's a death event. The death event will grant the step-up basis, but if there's no living trust, guess what happens? Probate court comes in to determine who will rightfully inherit Hector's building. And they will go down the family lineal line. If you got a spouse, kids, blah, blah, they will go down, and maybe they'll come to a determination that is an agreement with Hector, but he didn't have a living trust. So the minute probate court comes in, it's a pretty hefty price, because probate court charges a percentage of the fair market value. And then his family has to hire a probate attorney, pay the probate attorney to fight the court or represent the court. And at that point, we're talking about, as a starting, 5 figures of cost. Okay, so anyone who has a property should get a living trust and designate who's going to inherit it. And that will keep probate court out of your family affairs. So that's one option. We do also have options where perhaps I have one client I always talk about. You don't have to leave it to family. You can leave it to charities, because I have one client who single lady, owned about a dozen properties here in Southern California. And she says, Pat, I hate my family. I hate my family. I don't want them to have a single dime. I'm going to leave it all to charities. I'm like, okay, that's great. Do you have a living trust? No, I don't. Oh, no living trust? Guess where it's going to go? To the people you hate. You got to have that living trust. Okay. And then if you're charitable, like my client, you put it in your living trust. Upon my death, these assets are going to go to that charity, that charity, that charity. There's also many, many ways to design that. You can gift it not just upon your death. You can gift it now, get it out of your estate. And then there's also where, let's say, flash forward 30 years and Hector still wants that income and he wants to sell it. He's tired of being a property manager. This is where we're at. A lot of baby boomers are so exhausted from playing property managers. They want out, but they can't get out because of the tax bill. So what they can
Quick
do
second,
is
Pat,
sell it.
before you go too far on that. If you're watching this on YouTube and you're a baby boomer, you're tired of being a landlord, and you don't want to have to pay taxes, call Hector, call Louis. We're here for you. We'll help you out. Please continue, Pat. Sorry, I had to make that
Okay.
PSA,
So let's
public
say
service announcement.
exactly. So we got Mr. and Mrs. Baby Boomer. They're sick and tired of it. They got a highly appreciated building, low cost, low basis, don't want to be property managers. They sell it to you guys. They can do what's called a 1031, but not buy another building. They could 1031 into an UPREIT or a DST, that stands for Delaware Statutory Trust. Those are special types of trust which owns a commercial building. It could be apartment building, office building, Class A. So somebody else manages that. They would take that money, transfer 1031 into the Delaware Statutory Trust. They would own now a fractional share of whatever the ultimate replacement property is. There will be, these are pretty sophisticated setups, formal management arrangement. Then you just sit behind and collect your monthly rent.
Do syndications also work in that scenario, Pat, where you could 1031
Great question.
into a syndication?
Syndications are set up in the form of either limited partnerships or a limited liability company. The underlying asset is a real estate, but however, when they do the exchange, they sold their real estate, and then what are they getting in return? They're getting a share of either the LLC or the LP. That itself is not considered real estate, but the DST is, because the DST is a trust which is disregarded, and it's actually blessed by the IRS in the revenue ruling. And so the trust is disregarded. So in essence, the baby boomer is exchanging their old property they sold for another property, but a fractional share of the much bigger property. It is still property to property, not property to LLC interest.
Gotcha. Okay. So in the case of doing it in a syndication, it would have to be via like a TIC, right? Like a tenants in common, which is what I've heard. I've heard some people doing it.
That gets pretty complicated when we go down that path. But the DST is a much larger, setup. Larger. And again, they continue to collect the same rental income, perhaps, of course, not as much as they used to, because now they got to pay, the syndicator, the management entity. They can leave that to the heirs also, right? So upon their death, then the heirs can get the full step up. So same thing, but we got rid of the management headaches.
100% passive now, so they could then go
Correct.
ahead and really enjoy that retirement.
So they can get their mail money, like we say, the ACH or Venmo money every month.
ACH money, bro. We don't do mailbox money anymore. It's ACH money nowadays. Okay, yes. And then there was a question earlier on the 1031. How many 1031s can I do?
Unlimited.
So I can essentially 1031 till I die, essentially.
Correct. Yes. So there are some limitations. You cannot 1031 a property that you are planning to flip. So you cannot 1031 a flip. A flip is considered inventory. It's not an investment property, even though in our head it is an investment. Investment meaning like there's a tenant in there, right? And then you exchange it to something else with the tenant in there, or maybe a piece of raw land to be held as an investment. So you cannot exchange your personal residence. Although, of course, there's strategies designed to work around that. That's gonna we've also done that. Where I kid you not, a few years ago, I had a client here, and you guys know California beach area, how expensive it is.
Mm-hmm.
A little bit.
So the client's husband, who's now deceased, was a home builder, bought the piece of land. They constructed like on their own. The husband built that home. Nobody tracked bases, anything. I mean, maybe they cost them maybe $50,000. I mean, the work, you can barely buy a car for 50 grand now, but like back then, land, home construction, everything was about 50 grand. They sold it, and you better bet it's several $1 million.
Oh yeah.
Yeah. And there is also, if it's your primary, there is another tax code, section 121, home gain exclusion. So if you live in your home, you own it for at least 2 years out of the last 5 years, counting from date of sale, each person will get about $250,000 tax-free. We don't have that provision applicable to the securities investment side, right? Because there's no property. So in this case, the client, the surviving spouse, all she gets is $250,000, and we're talking about like several $1 million of hit. So there's another way to structure for that. So we work with clients on that, and there's many ways. That's why I said that's really earmarked for real estate and not applicable to regular businesses or securities investors.
Yeah. There's just not as many options. And obviously, this is what I've heard, and you're the expert. You tell me. What I've heard is that the IRS the government in general, creates certain tax laws for certain industries, such as real estate, because they don't want to be in the business of building these properties. And so they need private industry to do it. And so how are we going to get money to move? Well, give them an incentive. Is that about right? Or what's your view on that?
Yeah, there has been a lot of tax law changes, even from like the 1986 massive tax reform from the Reagan era, that changed real estate tax laws a lot. And from there, now, establishes a lot of the restrictions. And then the last several years, there's more tax laws in general that hits everyone. But keep in mind, like the real estate industry has pretty strong lobbyists.
Yes.
So they've threatened about 1031, they've threatened about mortgage interest, they threatened a bunch of stuff. I'm still chucking
And
away
a
on the
whole bunch of
taxes.
money
That
gets
hasn't
thrown to
been eliminated.
Yeah, I hear the 1031 every 4 years.
Right, yeah, it's gonna be gone, it's gonna be gone. Okay, well, it's still here, we're still doing it.
That's awesome. And so as we're rounding up the hour here, we got about another 10 minutes left. Pat, what is in your perspective from a CPA, the IRS tax perspective, what are some of the main differences in planning for retirement using a portfolio of equities versus a portfolio of real estate? Is there a
I'd say use
perfect
both
mix? Should you have
if
both? Should
possible,
you have
right?
one?
Right.
What would you say?
I'd say use both, possible. Um, and I know like a lot of my clients, the real estate guys, because they don't understand the market, they don't trust it, they don't, but the market guys, I see them going into the real estate, but not vice versa, interestingly. And for the real estate folks, I always tell them, look, you hear financial advisors about diversification and protect the risks and stuff. And I would tell my guys, like, look, you can have 10 homes, but 10 homes in 10 different locations is not diversification. All right. But in terms of like the retirement strategy, it's really simple. In my head, okay, if financial advisors always talk about like, like with modern medicine, it's improving, extending our lifespan, and there's always that danger. And they do those massive complex calculations. And, how old do you think you're going to live? Look at your family genetics, blah blah blah, and then they project out how much money you've got and whether you're going to outlive your money. And there's always that concern, always that worry. Everybody's worried about outliving their money. Well, in real estate, as long as the house is there, as long as the property is there, you're going to collect rent.
Yeah, it's producing income. That's right.
And rent goes up, rent doesn't go down.
Correct. And value goes up. So eventually you can always refi and try to refi and the same thing and cash out. And if you have to pay taxes a little bit on that money, hey, you have to pay taxes on the money because that's your income. But then again, what about putting properties on retirement funds or retirement accounts? What about IRAs, self-directed IRAs, where you can put money, have a property manager to take care of everything again? Is my understanding that if it has to be a retirement property, it has to be hands off for you, correct?
Correct. Yes, there's a lot of limitation. There are a lot of folks using their retirement, whether it be IRAs, 401ks, and then self-directing those funds outside of the traditional stock market, but into alternative investments like real estate. They can do deed of trust, the whole gamut. There are a lot of limitations. Of course, they cannot use that fund to buy it and use it for their own self. There's also a lineal test that you have to go through, and you can't rent it out to certain family members. So, the way I understand it, if you imagine a family tree, right? Parents, me, siblings, kids. So you look up, you look down, you cannot rent to those people. You look up, you got your parents, you look down, you got your kids, cannot rent to that.
It has to be an arm's length transaction, basically. So you
Correct.
get a realtor, the realtor brings somebody from
Right.
whatever, and that's it.
Right. Yeah. And then, it's all great, but then there's also the restriction that you got to get a non-recourse note because the retirement cannot sign for a recourse debt. There's also depreciation unfortunately, the downside is that these retirement plans do not meet the depreciation the way that we, as an individual owner could appreciate that. So there are pros and cons. They definitely could use the retirement funds for it. I have clients also using that to invest in deed of trust. So they get, instead of buying the property, they would loan it to, basically use your self-directed retirement plan as a private money lender. Issue the loan to other folks, and you collect, what is the going rate now for private money loan, like 10%, 12%?
12%.
Right. Right.
And I've also so because I've heard that opposing view, right? You can't take the depreciation, but also what I've heard some people doing is for those like flips, right? Those higher taxable items that you don't really get the depreciation, and it could really help you grow that account. So then you can leverage it for for much bigger things,
right?
Because that gain is tax free if it's a flip.
Tax deferred, depending on the vehicle.
Tax deferred, yes.
Unless they've got
there's no such thing.
There's no tax free.
No, there is, unless they're putting their money in a Roth IRA or Roth 401k. So you heard of the guy Peter Thiel, Lord of the Roth?
Yeah.
Lord of the Roth. He's turned a simple Roth into millions and millions. So we've designed those strategies also where these Roth 6,000-7,000, that's not going to make a dent. We have other strategies where our clients are putting away 6-7 figures every year.
And that's when that Roth can really do some damage, right?
Yep.
Yeah, so you can design some. We've worked with clients doing mega, not just backdoor Roth, but mega backdoor Roth. So not just your $7,000, but perhaps 5 figures of that in the mega Roth concept. So you're able to pack away, say, 50 grand into a mega Roth, take 5 years down the line. Now you got 250 grand, and you can grow that exponentially. Like you said, do the flips. All of the profits goes right back into that Roth account. It's tax free. You turn that 250 to 2.5 million, 25 million, totally tax free.
Now that's a fun retirement.
That's a nice retirement there.
Now that's a fun retirement right there.
Yeah.
I love it. I love it, Pat. Thank you so much for all this information that you shared. Team, if you guys have any questions, go ahead and throw them in the chat. The last question that we had here, Pat, was how's your approach different than other CPAs?
Yeah, that's a great question. Because I'm such a tax geek, with every new client, my first thing is, if they're willing to entertain me, we'll do a discovery session. I will review their latest tax returns, business returns, personal returns. Most of the cases, in majority of the cases, I identify missed opportunities. Mainly because a lot of times the folks go to their accountants, right before tax time. Now let's do my taxes. Well, yes, they did the tax return, meaning they took the tax forms, 1099s, W-2, blah, 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 whatever, put it in the software, and out come the return and what I call the damage. Here's the return, you sign it, and we're done. I take a different approach. We bring in our clients now for 2023, even though, we're just now wrapping up 22 tax returns, but we're kickstarting 23. I look at all of the missed opportunities that the new client comes in, they did not do. We restructure all that. We look at what's new in the pipeline, and we would walk our clients through, hand holding them, implemented all the various strategies. And I say that not just because we do anything aggressive. Everything we do by the code is supported. A lot of accountants are so busy, tied up, focusing on just getting the work done and getting the numbers in. There's nothing wrong with that, but let's take it to another level where, every day when I see a new client, I see a lot of missed opportunities that their old CPA did not help them with. We have one right now. The client, roughly overpaid 200 grand. Every year, 200 grand.
Ouch.
Yeah, I have a call with them, explain to them what I see. They go back to their CPA. CPA says, "Oh yeah, oops, we missed that." The largest one that we have that I've seen was 7 figures. I promised them 7 figures, $1 million. When all said and done, they got a refund check, $2 million. They thought it was a scam. We verified it. It's like, no, yeah, it's all legit, plus interest that the IRS owes you. So there is a lot to be done. The numbers are what it is, but how you present it and what you do comes with very, very different results.
I love it. And it comes from you digging in and really focusing in on each one of those clients. And I know that firsthand from hiring you and all the, just the wealth of knowledge. And I've had many CPAs, and I interviewed many CPAs before I hired you for our fund. And it was that approach that really honestly attracted me to working with your firm. So
Right.
that's
Awesome.
yeah, that's very important. It's that personalized, that being able, and I did not know that story, that you were geeking out on taxes as a kid, which is amazing. That would have made me hire you even faster.
Well, and the sad thing is there is no tax major in college, right? Like, so if they did, I would have probably even geeked out even more. But I find it really fun and interesting. Like, I see a problem and there's a way to solve it.
I love it. Well, while we wrap up the show here, Pat, what is one question that we did not ask you that we should have asked you?
Well, what's holding you back from having a discovery session?
There you go. I love it.
So the
If you are
information is
not,
there.
if you have not talked to a CPA recently, if you want a second opinion, call Pat. Her website is on the screen, as well as her phone number. And it's a matter of staying informed, team, right? It's just learning. One of the things
Right. And
that
tax laws are constantly changing, and not just you guys, my entire team's also learning because they're constantly changing new stuff and rolling out new rules. And so we, gives us job security. But it helps us, it allows us to help our clients, right? It's not, again, not what you make, but what you keep.
Exactly.
that is the perfect way to end the show. Drop the mic. It is not what you make, it is what you keep. I love it. Thanks again, Pat. We greatly appreciate your time and the knowledge.
Much
This has been
appreciated.
extremely helpful.
Thank
I've been
you.
taking notes. Even with all the times that we've chatted, I'm still taking notes over here on things that I could do without in my portfolio. So greatly appreciate it.